Well, good morning and welcome to the Experian Quarterly Business Credit Review for Q1 2022. My name is Gary Stockton. I work here in marketing for Experian. Before we get started, I'd like to get a few housekeeping items out of the way. If you would like to follow along, as I mentioned, we have dropped a copy of the PDF of the slides in the handouts area. We'll also include a link to the slides in our follow-up email. And if you've not yet received your copy of the latest report, you can download it at bit.ly, that's bit.ly/Q122MSR. We'll include that link after the presentation as well in a follow-up email. And today we will be discussing key findings in the Experian and Oxford Economics Main Street report for Q1 2022. Today's talk will be presented by Brody Oldham, Vice President of Commercial Data Science for Experian, and Oren Klatchkin, Lead Economist for Oxford Economics. Brody leads a team made up of statistical consultants, scientists, modelers, and engineers with diverse skills who provide clients with leading-edge analytics-driven information solutions, services, and data visualizations of actionable insights. He writes and speaks on behalf of Experian about trends in credit markets. Oren specializes in providing analysis on issues affecting the US economy at the industry and regional levels. Oren's past work experience includes working as a global economist at Citi. He holds an MA in International Economics and Finance from Brandeis University and a dual BA in Economics and International Relations from Bosch University. We encourage you to submit questions during the presentation today, so please use that Q&A applet in the GoToWebinar tool panel. We'll try to leave some time at the end to answer them. If we do not have time, we will route those questions to our experts to respond separately following today's webinar. Okay, I'll try and make a graceful transition here. And I'm just going to hand things over to Oren to begin his remarks. Oren.
Great, thank you for that, Gary. So let's get started here. Just move on to my next slide. Let's first talk about where the economy was in Q1. So overall, if we look at last quarter's GDP report, you know, the headline itself wasn't particularly too encouraging at all. The economy, according to the data, shrank at a 1.5% rate. But that's really due to only a few factors that we don't think will last, actually. So it was due to mainly imports being stronger than exports, slower growth among inventories, and less of a boost from the fiscal side. But if we look at the internals of the economy, namely the consumer, which accounts for, as probably some of you know, about 70% of the economy overall, that was very, very solid. That expanded at about a 3% rate, really seeing a boost from services spending and from goods spending as well. So very, very encouraging news on that front. We also saw businesses continue to spend overall. So investment was up about 9% in Q1. That was lifted by stronger spending on intellectual property, equipment spending, and there's also a boost from residential investment too. So while the headline itself was not too wrong overall, the internals of the economy were still very, very solid. And another reason why the economy was very, very solid is that the labor market was very, very solid as well. So the economy recouped about 1.7 million jobs in the first quarter. And as we can see here on this chart, most sectors have either actually had their total number of jobs rise above the level where they were before COVID happened, or they are very, very close to recovering the total jobs lost during the COVID crisis. The one sector that lags here, probably not too shocking to many of you, is the accommodation sector, as we can see here on the lower part here. That's still missing a significant number of jobs overall, but we do expect it to essentially recoup those jobs as we move forward. Another element of the labor market that we saw in the first quarter was that businesses remained very eager to hire, but they really just couldn't find anyone to hire for the open jobs. So whether you look at the data from the perspective of sectors, or you look at it at the perspective of states, we can see that the jobs openings rate rose and have continued to rise really since the start of 2021 and through the first quarter of 2022. So this is a very significant thing that firms overall continue to struggle with. They are looking to hire, but they really just cannot find the workers that they want to hire. I would note that there's some encouraging news on this, as we can see here on both of these charts. It is encouraging, I would say, that the jobs opening rate does not continue to actually tick higher over time. It seems to be reaching a level now where it's, whether it's again at the sector level or at the state level, is kind of, if you will, at this particular level and moving sideways over time. That to us signals that maybe we've hit the peak of the labor shortage problems overall, and we will see things start to improve as we move forward. And so in terms of what we do expect, we do think that the labor market will make further inroads towards a recovery of the lost jobs. We do think that the economy will essentially complete its overall labor market recovery in Q3, and the economy will add about 4 million jobs overall in 2022, which is a very, very solid number. In terms of the labor supply question that I'm sure many of you are, wanting to better understand, we do think essentially that the labor supply problems do slowly start to fade as we move forward here. Number one, the economy is overall learning to live with the situation that we are, currently in. So even if infection rates do rise, we don't see that as having a overall significant impact on the labor market. It would take quite a significant spike for us to really change our thoughts. And a additional element of this is that some of the fiscal support that was, lended to the economy in 2020 and in 2021 to help offset the impact is unlikely to be used once again. That's for a few reasons, some of which I will get to coming up here. In terms of wages, we have seen wages rise at a very, very strong pace overall. In Q1, wage growth averaged about 5.4% year on year. That actually firmed up to 5.5% in April, and we're going to get new data for last month that should be out on Friday, and that will probably show us that wages remained extremely elevated. We do, however, think that the labor supply, as it starts to ramp up, that should help to push down the upward pressure on wages, so that by the end of 2022, wages should be rising at a softer 4% year-on-year pace. Still quite elevated, but will absolutely be softer than what we've seen up until now. So no, comments on the economy would be complete without a short discussion on the state of the consumer. So if we look at the consumer overall, we see that actually it it is actually very encouraging to see that despite high inflation and rising interest rates, that consumers remain very much willing to go out and shop. If we look at the numbers here, which we can see that essentially shows us the pace at which consumers are spending, we can see that consumers remain very much willing to spend on goods overall and services, which I would note here as of April actually reached its level of where it was before COVID. So these are all in all, very encouraging things for us to see. We do expect some, if you will, softening in goods overall and a further uptick in services here as the economy slowly returns to the way it was before COVID happened. And so we do essentially think that consumers will remain very much willing and able to spend. We also think that because of that recovering jobs market and excess savings, these things are going to continue to provide a solid underpinning for the consumer as we move forward. Turning to the health of the corporate sector here. So if we look at the manufacturing sector, Q1 was, a pretty good quarter for the manufacturing sector overall. It continued to expand and continued to, see an influx of new orders, which is very encouraging. That said, it did confront a whole set of supply chain, or I should say supply side issues, whether it be raw material shortages, high inflation, hiring problems, logistical challenges. These were all things that continued to impede the manufacturing sector. But it's important to remember that the sector actually was able to withstand all those supply side problems. And we actually got data just now for May, which showed us that the sector continued to maintain fairly strong pace of expansion, which is very encouraging overall. Turning to services, services have continued to expand at a relatively strong pace, although we can see here in the chart that, overall the expansion did soften a bit in the first quarter. Services did suffer a lot of the same issues that manufacturing did in terms of the supply side. So again, labor shortages, raw input shortages, high inflation, all these things also affect the services sector because a lot of goods are also feeding into services. So they're all essentially suffering from the same thing. Again, though, I would note that despite all of the supply chain and the supply side problems, services continue to expand, which for us provides us a further indication that the sector will continue to expand and that essentially the supply chain problems will not force a contraction in manufacturing or services. So we overall are upbeat on both as we move through 2022. Turning now to sentiment. So we have seen, I will admit, a downward shift, if you will, in sentiment among businesses. Labor supply remains the key number one issue, but inflation is also a very, very important thing overall. So in the latest data that we have for Q1, we saw that actually 1 out of 3 firms cited inflation as their number one thing for them on their list. So we do think that continues to put pressure on businesses overall. I should note that share is actually the highest share, that 1 out of 3. That's actually the highest since Q1 of 1980. So it's very, very significant in terms of how much of an issue inflation is right now. On the right side, we do think that sentiment will not continue to fall much further in Q2 and through the rest of 2022. Namely, we think that that is the case because, as we can see here, firms are actually starting to, if you will, pull back their assessment on essentially how much they are going to raise their selling prices, which we can see here, and also how much they're going to wage their compensation costs. So that provides to us a essential indication that perhaps the overall tide is, kind of shifting, and that we shouldn't see a significant, or I should say, further retrenchment in business sentiment moving forward. We also think that businesses will continue to spend, continue to invest, because there's really a lot of reasons for them to continue to do so. So, number one, there is a significant need to essentially expand the economy's productive capacity. If there's anything that we've learned overall, is that we need to bring more of that production back here at home. Secondly, there is a strong need to replenish inventories. Even though inventories are actually back up to the level of where they were before COVID happened, they're still very lean overall. So we're going to see an additional impetus from firms to continue to raise their inventories. Also, there is a significant need to essentially offset the impact of a higher compensation cost. And so we're going to see businesses essentially transition towards more labor-saving tech. And lastly, the supply chain issues, which again continue to be a problem overall, those actually will force businesses to invest again. So we're going to see a lot of that strong momentum that we saw in investment in Q1 push through and move forward as we push through into the second half of 2022. Moving on to supply chains here, which I'm sure many of you want to hear about, as it is the number one thing right now. What you're seeing here is actually an index that we have that essentially measures supply chain stress. What we have done here basically is decompose the supply chain according to activity, transportation, prices, inventory, and labor. Overall, in the first quarter, we did see that supply chain stress did rise. Again, many of the things that I've already said are going to be visible here in this indicator. But moving through the first quarter and also into April, which is the latest point for which we have numbers, we can see that inflation stress remained very high. We did see some moderation in issues on the transportation front, particularly in April, but that really is not, to us, a significant improvement. Part of that is driven by China's approach to COVID, namely the fact that if you have, zero approach to COVID, you're going to essentially be having less economic activity, and that economic activity filters through the logistics sector to impact us here at home. But that really is an artificial improvement in the numbers. We don't see that really changing overall. That said, there were some positive things that I should say wasn't entirely negative overall. We did see improvements on the activity side. We also saw improvements on the inventory side. And as I mentioned earlier, we saw improvements on the labor side. So there are some positives here, but overall the supply chain remains very stressed overall. We often do get asked when the supply chain situation will improve or essentially return back to the way it was before COVID happened. For us, we actually don't see that happening anytime soon, and really it's highly uncertain whether or not the supply chain will actually go back to the way it was before COVID. There's a lot of things happening here at home for us in the economy that are forcing changes in the supply chain. There's also the geopolitical issues that are going to continue to impact the supply chain. And as I mentioned, the zero COVID approach in China will also have an impact. Now, I know that some of the cities in China are actually starting to, loosen their COVID restrictions, but we do think that activity will continue to be significantly impacted, and so we don't see supply chain stress coming down really by any significant measure anytime soon. And now we're going to actually have our poll on inflation.
Okay, folks, you should see the poll question. I can see the responses coming in now. We've got about 47% of the vote. Let's try and get as many votes as possible on this one. It's quite an interesting poll. What do you see growing faster in the next 12 months? Revenues or costs? And share those results. It looks like 86% for costs. Inflation, it's top of mind. Okay, I'll go ahead and I'll hide this poll for now. Get back to the slides. Okay, continue.
Very interesting, very interesting. It ties well actually to some of the comments I'm going to make now. So moving on to inflation, we did see inflation ramp up significantly in the first quarter, both from the goods perspective and a services perspective, as you can see here on this chart. We did get some positive inklings on the inflation front. In April, we did see headline CPI, which essentially is a headline measure of consumers' inflation and how much more they're having to pay. We did see that fall back a little bit. The headline number fell to 8.3%, and the core number, which takes away the energy component and the food component, that actually fell down to 6.2% year on year. This is, I would say, a notable change because it's actually the first time that inflation has fallen at the headline and core level since summer of 2021. There are also some positive signs for inflation from the producer side and also from the import side. So we're seeing some, hopefully fallback in the inflation pressures as we move forward here. We do think, however, that it's going to take us a long time to return to the 2% inflation level that we saw before COVID happened, and we don't think that that's going to happen very, very fast. So essentially the main reason for that are we don't see that fundamental environment of strong demand really changing anytime soon. And as I mentioned earlier, the supply chain will continue to remain under severe stress. And so this environment essentially will keep inflation from falling down too quickly. And we actually have it forecasted that to average 6% year on year in the second half of 2022, which is quite a hot number, if you will, on the inflation front. Okay, well then I'll go ahead and start. So some of you may be wondering, in this high inflation environment, which industries will actually do best overall. So we actually recently completed that, and we found that financial services, tech, real estate, consumer staples, industrial goods and services, insurance, and consumer goods and services, which altogether represents about a quarter of the US economy, those are actually the industries that are best positioned to weather the high inflation environment that we are going to see. The margins in those industries are the highest and they're the least volatile. And the production of those is actually concentrated among relatively fewer number of firms. So we do think that those companies which did enjoy that, those sectors which did enjoy high pricing power in the first quarter of 2022 will continue to enjoy that pricing power as we move forward. The other integral component here is margins, which should be the slide that you are seeing now. Okay, so on this front, companies, as I'm sure many of you already know, have been able to protect their margins by cutting costs and essentially passing on their higher input cost pressures onto their customers. That was essentially what we saw in the first quarter. We do think that that environment will change here. There will be some compression of margins as wage growth remains fairly elevated and the productivity gains do start to slow. You might be wondering if this means that we're headed for a recession. In our view, the answer to that is actually no. So margins are expected to fall, but they actually don't provide a very clear indication of where we were before, I should say, whether or not we are actually headed for a recession. The lag for them is about 1 year to 5 years on the margin indicator. And furthermore, we would actually need a sharp contraction in margins and for them to stay low for long in order for it to send a strong indication of a recession. That said, lower margins will be a headwind for the economy through the rest of 2022. Now move on to our financial conditions indicator, which I believe should be showing right now. So another reason why we don't think that there will be a significant risk of a hard landing for the economy is that financial conditions overall remain fairly accommodative. What you should be seeing here on this slide is essentially an index that collects data points from various areas of the financial market. So interest rates, equity prices, equity volatility, these kinds of indicators, we basically combine them all into one, and we in turn calculate how much of a weight or how much of a support they put onto the economy overall. So those actually, this indicator actually shows us that it's not putting significant stress on the economy right now, and so we're fairly upbeat on the economy moving forward. And we should be now looking at our recession model slide, and that should be showing us that our model shows us that recession risks are not particularly high right now. We have an assortment of models that do show us what is happening, and the output of those models shows us essentially that the risks have risen, but they're not materially higher. And also they have not reached a level where we think that recession is definitely going to happen. So we would need to see a further uptick in that recession risk model for us to be a bit more downbeat on the outlook moving forward. Okay, so I'll come back to that in just a second here. Let me wrap up. So the economy, as I mentioned, did contract in the first quarter, but we think it will remain fairly upbeat overall. Growth will average about 2.5% for 2022 overall. The economy will receive a tailwind from consumers' excess savings and businesses' willingness to invest, but there will be headwinds from the supply chain situation, high inflation, and tighter Fed policy and also fiscal policy. We do think that growth slows to about 2% in 2023. There will be greater headwinds, if you will, from tighter Fed policy, no support from the fiscal side of any meaningful measure. It's also going to be slower income gains and also less of a boost from excess savings. In terms of our metro outlook, so the metros, so this essentially shows us our medium-term forecast for the metros, and we essentially think that at the metros with the largest tourism base, so your Orlando's, your Las Vegas's, those cities will outperform. That will be essentially a factor of the recovery in leisure and hospitality, but those will continue to do well as well. We do think that as we move forward, also the tech-heavy sectors, or sorry, I should say the tech-heavy metros, your San Jose's, your San Francisco's, your Seattle's, those will continue to perform very well. Southwestern mountains and the South will also continue to perform relatively well. So your Austins, Denver, these cities. Meanwhile, the East and the Midwest will lag, and I'd also note that the large cities in the U.S., so Chicago and LA, will lag overall, and New York will perform a bit better, a bit stronger than the national average. Coming to my final slide here, I just wanted to note that while the fiscal side of the economy won't provide much of a lift going forward, we actually will get a lift to the economy from the infrastructure legislation that was passed last year. So we did some recent work on this to basically try to calculate the impacts of the infrastructure investment to the economy overall. And we saw essentially that it will provide a boost to the economy worth in an average of about 0.2% in 2022 and 2023. And then construction will benefit the most. The lift to construction will be about 5 times larger than the larger economy, and manufacturing will also benefit as well. And we can also see that on the right-hand side here with the jobs estimates. So the construction sector will add about 10,000 more jobs by the end of this year, and that boost will continue to increase as we move forward. Manufacturing will also get a lift, as well as all of the other sectors in the economy as well. So thank you very much for your time, and I believe we can move on to the next section now.
Okay, thank you very much, Oren. Let me just go ahead and hand the keyboard control over to Mr. Brody. You should be okay now, Brody.
All right, thanks. Thank you, Warren. Appreciate the overview on the economy and where we're headed, and how we see the next few years coming. We used to look at it in quarters. Now we look at it in years as we progress and look for opportunities to help small businesses. Certainly, when we think about the U.S., we look at our small business credit data. Oren and I have been looking at some of the information that we see in the trends in this data. When we think about small businesses here at Experian, what our mission is to get out and make sure that all businesses have a voice, are accounted for, and are visible within the credit data, so that you as a service provider, creditor, lender can have access to past information. And so in the end, our small business can gain access to funds more easily and at a lower cost point. Really the purpose that we have in doing a lot of the work that we have here is to help the owners and the small businesses themselves. So you're going to see a lot of that data included here today. We're going to be looking at some of our small business financial exchange data. We have looked at in another report that's coming out, our Main Street report. We'll be looking at some of our SBCS data, our small business credit share data. So I encourage you to take a look at both resources as we go forward. Now, as we look at some of the data today, I always like to start with the consumer. This is like the small business owner. When we think about our connection between businesses and their owners, a lot of times that business owner is using some of their own credit to help support the business itself. So we take a look at the small business owner first, and want to just give you a feel for the market. Oren gave you a bit of some information just right up front about how the consumer is feeling. Confidence is still low, but they're spending and they're out there. We see that savings rate is going down below 5%, but the consumer is still spending at an expedited rate. That means that they're out there. Even though they feel bad about the economy, they're still spending. While we're getting to the point where if you look out, you're going to see that inflation is starting to hit some of our consumers, and it really hits that lower segment of consumers that are in our lower income segments harder. They have difficulty moving from, they've always bought the store brand. They can't move from a premium brand to a store brand, so they're caught. So we're seeing a lot of that price pressure for consumers as we get into this year. Well, what does that mean? That means the consumer is going to reach out for more credit products to try to fill that gap in cash flow, in savings, in a savings gap, and so they're going to reach out for some of these products. What Oren talked about and what we see here in the consumer credit data is that you're seeing that our unsecured products and credit cards are still expanding, and we're seeing growth here in the market. So that is picking up in an unsecured set. We see our mortgage and our auto kind of dip a little bit over the past 2 quarters. That's due to inventory constraints, and what we're seeing there, we're going to continue to see that through the next year. So we'll see that challenge there. These higher prices that we have on homes is helping that equity pull for small business owners. They're able to still pull some cash out there to keep some of that gap maintained. What you will see here also on the far right is that delinquencies are going up a bit as consumers get a little more crunched going into this year. Still at a very low level, so performing still very well overall. in consumer credit. In the middle, what you're going to see is a forbearance chart. This is where some delayed payments have been for consumers. Some of this debt is coming back on to the balance sheets of consumers as these payment holidays are going away. Some of the moratoriums have gone away in the past year. The debt is being reassumed. That's going to mean that the available discretionary dollars that are available for our consumers and small business owners is shrinking a bit. So the amount that they'll be able to pull and just throw into their small business is tightening and tightening as we get into this year. Now, when we think about consumers also, you think about our labor market. So they're out there. There's a big opportunity for them to switch jobs, get a little higher wages. Warren talked to some of the challenges that we're seeing with small businesses and the types of industries that have gained and lost, and which industries are recovering as far as labor participation. What we've also noticed is that a lot more of our labor force is moving from the coast into the interior of the US. So more of that transition. What that means is for states like California and Florida that depend a lot on leisure and hospitality, a lot more of their resources are coming in for different types of manufacturing or Amazon jobs, driving a truck around. All those are very attractive in lower cost areas. So that may be pulling more into the central US as we go forward. So labor force is transitioning across the US, and that's a big deal for our small businesses. So they try to get quality labor to support their business going forward. The other thing that we're seeing a lot of are new businesses that have been just established, place their application within the past year. They're trying to get themselves up and going. And we've seen that at a rate of about 400,000 per month. And that's continued at this elevated level. You can see that in the top left. On our business profile, our small business profile in the SBFE, what we're seeing is that accounts for about 40% of the small businesses that are on file have been in business less than a year. Pretty new. A lot of new ones out there. SBA looks at the survival rate of these businesses. About 60%, a little bit more, are surviving more than 2 years. So it's a good opportunity to evaluate policies as you're looking at how you support small businesses, adjusting from maybe the standard traditional 2-year review of historical information to be able to lend into these areas, taking a look at opportunities to do that for a younger business. You'll see also that there's a different breakdown as we look across the US of where these businesses are forming, and also the breakdown of minority-owned businesses. So a lot of us have opportunities to get and engage with our CDFIs, an opportunity to support communities that need help. This is a way to dig in and look for opportunity areas where you can place money and we can help some of these small businesses to grow and become more visible and get funding into their hands as we go forward. So there's a lot of those out there, a lot of opportunity, and that has continued to be very stable over the past year. Now, when we think about installment lending, I think it's important that we look at, as we talked about, consumers are getting a little tighter, savings rate going down, business owners a little tighter on cash. They're thinking about what they're going to do in the next year. Is a recession coming? Is it not? A lot of the reports and economists, as I talked to Warren and others, don't see a recession really coming very quickly. It's out in the future, way out in the future. So as we look forward, we're still seeing growth and a bit of a reset here in our 2022 and into 2023. So not so much a recession in the economy, but more of a reset and slowing and cooling of that economy. What that means is that consumers are going to be tighter. They're going to look for credit. Business owners are going to be tighter on capital because there's not as much stimulus as ended in the past year. So they're going to be looking for some of these gap fillers. And what we're seeing, of course, is that realized within our commercial data here at Experian. So you'll see that in the top right. So as far as installment loans that we're seeing, that continues to increase as far as origination. Small businesses are out there looking for those types of loans. You'll also notice that red line up above, it's going up. That means that the value of those, the balances are growing as well. Now, when we look at the types of criteria that you're using to onboard, we see that it's fairly stable. Down in the bottom, you'll see some risk breakdown by our IPv2 score, breaking down in tiers of high risk to low risk. You'll see that all the tiers are pretty stable throughout the past 2 years. So not much has changed there, keeping it fairly comfortable for small business owners and at a constant rate, not any tightening as we look at potential a potential slowdown in the economy into the next year. So everybody's keeping it about the same. Now, when we look at delinquency rates, that's often what will cause a lender or creditor to say, is it time for me to tighten my criteria? Well, as we look across the different regions, you'll see that they're all fairly low, continuing to trend down in sloppy, slow pay. We always look at that right off the beginning, right off the front to say, hey, if there are challenges in that 1 to 30 days, that means they're holding their cash a little bit more. They're trying to figure out, they're a little slow to pay you back. It may be that they're paying other bills and looking at how they, just the way that they manage their cash flow. Well, what we're seeing is that delinquency is still in the slow and sloppy pay range. That 0 to 30 are still pretty low across regions for installment loans. You'll see that what's a good thing to see on the right-hand side of this slide is when we look at the difference between a 60 to 90 days, or that pink line, and a 31 to 60 days. So these are a little bit later stage delinquencies, not too far late stage, but a little later stage. What you'll see is that divergence in the two lines. What's good about that is that we're seeing that not as many of those that are rolling or in a 31 to 60 days past due are rolling into that 60 to 90. So that's good. We want to keep that where they're recovering, they're curing as they go forward. So we want to keep to see that trend with that divergence between the two lines there in 30 to 60. Now, when we look across the portfolio, it's always good to look at year over year to see which industries are having challenges. And it's good to see this because you want to see, is it supply chain? Remember when we got together a quarter ago, the supply chain industries were really impacted by the challenges that we're seeing out in the ports, getting product in-house, being able to get some of the mining challenges that were out there, the regulatory impacts, some ESG reviews. We're keeping some of those industries in a little bit more of a volatile state, and so their delinquencies were going up within the portfolio, and that was causing some risk to increase. We're not seeing so much of that here in the first quarter, and that's good. So for our installment lending, we see it pretty consistent. Construction had a bit of a hard time in the first quarter. We're going to see in the second quarter, you know, as we see interest rates rise, we're going to see not as much press, or as interest rates rise, we're not going to see as much interest in new home builds, and so we'll see lumber prices and other things start to drop. I think that'll help a bit, but it will put a little bit more pressure on the construction industry as we go into this next year, and you'll see that already starting in some of our installment loans that we're looking at already. We'll see some here with agricultural challenges as well. So you think of a farmer out there trying to bring in their field, and I live here in Texas, a lot of farms. Fuel prices have gone through the roof. I put a half a tank of gas in my car yesterday. It cost me almost $100. So pretty extraordinary as far as increase in fuel costs. We see that for our farmers as well, the cost of bringing in the crops and maintaining those fields, much more expensive than they used to be. So we'll see some delinquencies rising within this industry as well. Now, when we look at commercial cards, so let's think of that unsecured product. This is generally what our small businesses will lean on right up front. If they're having some challenges, we continue to see originations increase here on the right-hand side of the slide. You'll see those originations increasing. That's good. What we've seen over the past couple quarters is that the balance amounts, the balances on these cards, what's being offered as a credit line, has been decreasing. That means a lot more originations are going out with lower lines. What we're starting to see now, and which is a good thing, is we're starting to see those lines pick back up. That means that our lenders, our creditors are starting to feel more comfortable with what's being originated and the performance with these businesses, and so they're allowing a little bit more, a little bit higher line as we go forward. And that's what small businesses are looking for right now to fill some of those gaps. Again, stable as far as origination criteria, which is really good. We look at delinquency rates across the U.S. Again, 1 to 30 days past due, still maintaining a low rate, keeping it pretty consistent. A little bit of seasonality in there, but still keeping it very consistent and low. When we look, again, we're seeing that gap between our 30 to 60 and 60 to 90 bars, which is good, and that spread continuing to widen. We want to see that. It means our small businesses are performing very well. When we look at the portfolio for unsecured loans, I want to point your view to the far end, to the far right. What you're going to see here are two boxes circled. One, again, when we look at transportation, we have a lot of customers that will look at fuel, fleet costs, things like that, and they're seeing some challenges again. Certainly with transportation, we'll see that with the supply chain challenges that we're having. But with the fuel costs rising, we're going to see some challenges in this industry. Certainly some more delinquencies hit. Hoping to see those fuel costs go down as some of the reserves are being released probably late this summer. And so we'll have some cost support there, which will help some of these industries to improve a bit and kind of catch up as we move forward. What you also see is wholesale trade. So a lot of that inventory being captured there. There's a lot of containers full with inventory that was pre-ordered for this year, so sitting in port, sitting in storage locations. So warehouse, we may see some up and down, a little bit of volatility within our supply chain partners again, like we saw in the past couple quarters, just not as strong as we did in prior quarters. We won't see that much volatility through this year, so it's improving a bit. Now, what I encourage you to do, as you're thinking about how to help small businesses, and we look at the market and we think there's going to be some, we still already see it with the Fed, some tightening that's happening, inflation up, costs up, revenues down as consumers pull back just slightly, looking at their discretionary spending. You're going to see some of those small businesses that are focused really very specific in areas. Much more of our micro and smaller businesses are going to have challenges. To help small businesses, one of the things that I encourage you to do is review your pre-treatment policies as we get into this year. It's going to be very important. One of the things that we like to look at is doing a matrix between a collection type of a score and a credit score to see what groups, and you'll see an example of that on the right-hand side of the screen. What are some of the actions that you should be thinking about when you look at these small businesses? Because remember, if you take a small business and they're in trouble during one of these downturns, we saw this during COVID, we even saw it during our mortgage crisis back in 2007, 2008. As we're helping small businesses through these challenging times with pre-treatment strategies, getting them on payment plans, helping them to recover and keep their feet under them, the loyalty there remains for years to come. So I encourage you to take a look at policies now before we get into the mid part of this year. And you're going to turn some of these on, look at resourcing at this point, see how you can support these small businesses as we go forward. Now, some of the insights that we saw today, the things that we're focused on for as we are interacting with small businesses, with lenders like you and creditors, is we've really seen a lot in digital interaction. The customer is really looking for opportunities to engage in a more GUI fashion. You know me, I know you, let's work together. I think that's going to be very important in the customer experience as we go forward through this year. Also making sure that your customer is visible. So if we have these small businesses out, getting that into the bureau's view, allowing that customer and their good history, good repayment history to be seen so that they can get funds a little cheaper as we get into this next year and it gets a little more challenging. A little better score is certainly going to help small businesses. We look at the small business creation, again, a policy change to look at. If you're looking to get into a very large market, again, around 40% of what we see on our internal file are new businesses under a year. A lot of those will survive, more than 60%. So it's good to take a look at your policies now to see how you can support some of these younger businesses as we go forward. And I would say we're going to continue to track labor changes over the next year. We're at that point where it's going to be between, 3 or 4% unemployment rate. We'll manage around there. It may go up, it may go down a little bit from there as we get into some of the changes that we'll see over the next year and some of the supply chain challenges, some of the import challenges that we'll have for goods and services and increased prices that we'll see in costs of those here in the US over the next year. So, we're going to be watching this. That will impact small businesses' ability to function. And certainly within certain regions, it's going to have more impact than others. So I would say as we are reviewing this, again, just to give you an overview of the way that we're seeing how the economy is rolling. From the perspective in the first quarter, very strong, hot economy. Small businesses performing well, good cash, capital, they're capitalized well, a lot of capital available for them to move forward. As we get into the second quarter and third quarter, that amount of capital that they have in reserve is going to shrink. They're going to be looking for more credit products. And so we'll see a bump here in originations of credit products going forward. What we'll also see is small businesses looking at whether or not they should be investing now or should they be preparing. So you'll see some kind of hold back, looking potentially for some longer term lending facilities versus short-term unsecured. So a little difference here that we'll look for within the next year, but some changes in behavior, certainly with small businesses as we go forward, and differences in the way that their industries are interacting with the market. But again, we're in a strong position in the first quarter. We're going into some tightening that we're seeing from an economic position, not so much from a credit position into the second and third quarter. But I think that will be businesses are going to do pretty well. We're kind of set and priced into where they want to be over the next year. So very positive position. So as we close out here, Gary, I wanted to see if there were any questions that Warren and I could answer for the attendees. Anything that we could talk to?
Yeah, we had quite a few questions come in. I suspect a lot of the questions around inflation were answered through Oren's section. I'm just looking here for some of these new questions here. There's one on delinquency here from Abhishek, and he asks, I think that's a he. I apologize if I didn't get the gender correct there. Are the actual delinquencies higher than what we see in the chart? The originations are increasing at a faster rate. So irrespective of the denominator increase, we are seeing an uptick in the delinquency charts. It doesn't say what slide that was, though, unfortunately. We could maybe look back at that was around 10:42 a.m.
Well, I would say also, as we're looking at originations, we are seeing those go up. So as we look at the denominator, you will see some of those delinquencies go up, but the rate of that delinquency across the portfolio itself is not increasing at a rate. It's still well below where we would expect to be at this point in time. And I think that's, as we look at the strong spend that we're seeing here in the US from our consumers, that's really keeping those delinquency rates tempered at this point. We want to continue to see that strong spend out of our consumers. And as we look into this next year, we're going to see some of those headwinds hit consumers that may create some expanded delinquency opportunity within the set that we have. But again, small businesses are in a good position. Consumers are even in a good position as far as their balance sheets. So it's going to be a little while till we see that really any type of acceleration. It should stay pretty steady at a below pre-pandemic level.
Very good. There was a good question here from Philippe during Oren's section. And this question, which has the biggest impact, energy or China supply chain?
That's a very interesting question and a multifaceted question, I could say. I would say that the energy component probably has a larger effect. We know that the consumer makes up a bulk of the economy, about 70% of the economy in total. And we become more dependent on the energy sector for economic activity in general in the past 10 years or so, with the boom in shale overall. So that has an impact. But I don't want to completely eliminate the importance of China. We do import a lot of stuff essentially from overseas. That's having an obvious impact on our supply chain. So I think that plays an important role as well.
Yes, very good. There's several other questions. We'll try and do a follow-up blog post on the responses to these guys. But do want to thank everyone for coming today. We are going to have to wrap it up. I want to thank Oren from Oxford Economics for presenting today, and also the hard work on this is the first Main Street report with Oxford Economics, and Oren put a lot of hard work into the report. Please download that after the webinar if you haven't already got your copy. And also for more information on Experian, you know where to find us, experian.com/B2B. Also, one last little plug here. Please take a moment when you exit today to fill out that exit survey. It really helps us develop good webinars and understand what it is that you would like us to cover on future webinars. So with that, I want to thank everybody. Ladies and gentlemen, have a good day and thank you for coming.
Thank you.
Thank you.